What is sweat equity and how does it work? Is it important in business? And what about its worth? Let's discuss all these questions today. So, welcome to the Upstep Financial. If you want to build a lot of money, then this channel is for you. Before we continue, please take a moment, go down and smash the like button and subscribe to connect with us. Sweat equity is the sort of investment that measures time and effort put into a venture. It is the proprietorship, interest, or increased value that results from the owner's difficult work. In startups, sweat equity may be an immense contribution of founders who may have not had the cash to contribute. How does sweat equity work? Sweat equity initially referred to the value-enhancing changes generated from the sweat of one's brow. So, when individuals say they use sweat equity, they mean their physical labor, mental capacity, and time to boost the value of a particular project or venture. Sweat equity is also an essential part of the corporate world, creating value from the effort and toil contributed by a company's owners and employees. In cash-strapped startups, employees and owners typically accept salaries below their market values in return for a stake in the company, which they hope to profit from when the business is eventually sold. Let's understand the concept of sweat equity with the help of an example. Habitat for Humanity homeowners must contribute at slightest 300 hours of labor to construct their own homes and those of their neighbors before they can move in. Besides expanding home affordability, the program also gives property holders a sense of accomplishment and pride in their community. Sweat equity can also be found in the relationship between proprietors and their tenants. In trade for maintenance work, building proprietors and landlords may provide an equity stake in the property or, in the case of a superintendent, available housing. But what about the business world? Let's say an entrepreneur who invested $1 lakh in their startup sells a 25% stake to an angel investor for $5 lakh, which gives the business a valuation of $2 million. Their sweat equity increases the initial investment value from $1 lakh to $1.5 million or $1.4 million. Shares may be issued at a markdown to directors and workers to hold talent. In contrast, execution shares are granted if specific measures are met, such as an earnings per share (EPS) target, return on equity (ROE), or the total return of the company's stock concerning a list. Typically, execution periods are over a multi-year time skyline. For instance, private equity (PE) firms may save a critical minority stake in procured companies from incentivizing, adjust, and management their interface with the PE investors. We are now moving towards an important part, that is sweat equity in real estate. In real estate, sweat capital refers to the value of unpaid work that results in a market rate value increase in the property price. The more changes are included to a house, the more sweat equity is included, and the house's more fantastic value. An example of sweat equity is a person who spends time renovating homes and selling them at a better cost. The difference between the home's value before renovations and the home's market value after repairs represents the sweat equity. That's simple. In many cases, individuals have to use sweat equity, their time and effort, to contribute to a company's victory. That's because there's exceptionally little capital to pay salaries. Unless you're the proprietor, everybody anticipates being paid for their time and vitality. After all, no one needs to work without charge. Whereas a company may not yet have sufficient capital to pay its employees, it can compensate in other forms. For instance, new businesses may give key employees an equity stake in the company. Other, more set-up companies may provide their workers shares to compensate their sweat equity. Friends, I hope you are enjoying the video. Don't forget to subscribe to Upstep Financial to stay in the loop with our unique videos. And if we missed something important so far, comment us below. Keep watching. Sweat equity. Is it worth it? Let's see. Many reasons why startups rely on sweat equity to get things off the ground. But are sweat equity worth it? The media is littered with stories of co-founders who have split trade into troubles, which can be followed back to the fundamental challenges of sweat equity. However, in those early days when cash is tight, The offer of sweat equity is undeniable. This video will open your eyes to the benefits of sweat equity and caution you to the most common pitfalls to avoid. So, you can choose for yourself whether sweat equity is worth the perspiration. So, what's the appeal of sweat equity? Saves cash. Let's face it, no startup is ever inundated with cash, so anything that avoids cash burn but still gets things done is bound to have appeal. If salaries can be balanced or diminished by offering shares in the business, or if the software can be built for offers rather than cash, who wouldn't consider these choices? In the early days, most startups will consider anything to induce their business off the ground. Give access to abilities and experience you couldn't otherwise afford. Offering sweat equity can provide new businesses opportunities to draw in a co-founder or key employee of a caliber they won't otherwise be able to manage. Picking up shares in a full of guarantees has value, especially to somebody who sees their own ability to extend that value. Aligns objectives and motives. A win-win situation is made as employees with sweat equity work to develop the business, expanding the value of their shares as the business grows in scale and victory. But it could leave you wishing you'd taken a cold shower. Ensure you are compatible. Return from equity comes over the long term, so you need to be sure you and the person getting sweat equity are compatible as with any long-term relationship. For example, are you sure the individual to whom you're offering sweat equity is as committed as you to the project? Will they adhere to it through thick and lean? Do they share your vision and enthusiasm for the business? Sweat equity can cause unintended delays. Done well, sweat equity aligns inspirations and deliverables, but it can have unintended side impacts. If, for example, you're offering shares rather than payment for work embraced, be aware that no one can survive without any pay. If you merely offer shares in exchange for work done, how do you anticipate that person to live and pay their bills? If a person doesn't have adequate money in the bank for basics, they will be forced to work on the best of what they are doing for you, decreasing the time they can spend on your project. The same applies if you offer sweat equity to a business. If the business doesn't have the revenue to pay salaries, they will be constrained to take on other contracts, affecting the time they convey your project. Are you willing to live with that compromise? Be sure the value exchange is clear, specific, and measurable. Don't hand out the guarantee of the equity willy-nilly. Be clear about what you're offering and what you anticipate in exchange. For both parties to feel happy, there must be impartial value. That will require definition and specifics. Do not depend on the implication. You have great communication aptitudes and a strong network, so I thought you'd make presentations. Be very clear about what you need. I am offering X% of offers in this trade in exchange for presentations and support in closing a venture deal with Y and Z investors. You might break the investing of equity into stages based on conveyance triggers. Reach agreement about value sooner rather than later. The greatest challenge with sweat equity is coming to an assertion about fair value. It cannot be easy to value new businesses and early-stage businesses. Traditional models for valuing enterprises do not work because they depend on steady and predictable incomes, which exceptionally few early-stage businesses have. Instead, you're left valuing the trade based on its market potential or the assets as of now made by the exchange. On the other side of the coin, how do you value the time given by the individual being offered sweat equity? Do you value their time as in case paying a compensation? Or should you value what that time makes? A working platform, creation of key organizations, delivery of first clients, and revenue. There is no denying it. Valuation is tricky. It can cause the allocation of sweat equity to be postponed or handled in a conversation. That is when a misunderstanding occurs. Complicated as it is, if you want to avoid a cold shower down the line, formalize what is being offered in terms of sweat equity and get it to understand early on. Alright, guys. If you enjoyed this video and felt it was valuable in teaching you how to bring more wealth into your life, please share it with your friends or anyone else who might benefit from this information. Before wrapping up, to make sure you leave a thumbs up and subscribe to our channel. If you want to change, your future takes action, and take action right now.